Hey guys, I have started looking for some investment opportunities in the travel industry because of the signals of strong recovery discussed in my previous video, and Service Properties Trust, a real estate investment trust, is one of my bets on the recovery of the sector. Because first thing first, it is not a pure play hotel REIT, and that is one of the key reasons for me to take up a position in it. A pure hotel investment may be a riskier bet for now if the recovery takes longer than expected due to new waves of COVID-19 virus strains. This will result in such pure play travel or tourism business to burn more cash and take on more debts to keep their lights on. Anyway, SVC has two reportable segments, hotel investments and net lease investments. Currently, it has 310 hotels and 798 net lease properties in its portfolio. Observe from the chart here, based on the investment value, hotels make up 57.5% of its portfolio, while net lease properties makes up the remaining 42.5%. In total, they are worth about $12.2 billion. For its hotel segment, there was a substantial rebranding effort going on recently. The management of 200 hotels have been transferred to Sonesta from IHG, Marriott and Wyndham. As for its net lease properties, they are rented out as mainly service-oriented retail properties such as restaurants, movie theatres and grocery stores. More than 50% of these properties are leased as travel centres to Travel Centres of America. These travel centres primarily provide goods and services to the trucking industry, including the refueling and maintenance services for trucks in the US, and of course these centres provide dining and other consumer services to these travellers and motorists as well. Understand that in a pre-COVID world in 2019, its hotel operation generated about 87% of the overall revenue, while the net lease properties generated the remaining 13%. In terms of its bottom line, hotel operations contributed about 70% and the net lease properties generated the remaining 30% of its overall earnings. Of course, the outbreak of COVID-19 in 2020 has heavily damaged the travel industry, and SVC is not spared as well, with its hotel revenues slashed by more than half and reporting a loss for the fiscal year of 2020. Since we are investing for the recovery of the travel sector, we will not dwell too much into the losses of its hotel segment as it is expected. But understand that SVC's hotels are weighted more towards the extended stay category. In fact, its 165 extended stay hotels generated much higher occupancies of 54.5% in the first quarter of 2021 compared with occupancies of 31.2% and 28.7% for its 94 select service and 51 full service hotels respectively. And management expects its suburban extended stay and select service hotels will outperform its urban full service hotels in 2021 and 2022. Also, here I want to highlight that the rebranding effort has produced results as expected. 115 hotels were rebranded to Sonesta from IHG, Marriott and Wyndham between September and December of 2020, including 111 hotels in the month of December itself. As such, it has impacted its hotel performance negatively during the transition period. These 115 rebranded hotels have since seen their occupancy level, revenue per available room and average daily rate recovered in April 2021 to October 2020's levels the period before transition. This is a very positive sign as it confirms that rebranding from previous international names like Marriott would not result in a loss in business for its hotels. However, overall, these metrics used in assessing hotel performance are definitely still way below the levels in a time before COVID-19. This brings me to the other important portfolio segment of Service Properties Trust, which is its net lease retail properties as briefly discussed earlier. This had been a smaller segment to SVC's income previously, but with the outbreak of the pandemic, it has become a very important component of its portfolio, without which the REIT will be in a dire situation with its hotel properties still making losses. As you can observe from the chart here, SVC's net lease properties tenants include major brands like Travel Centres of America, AMC Entertainment and Pizza Hut, just to name a few. Because of the essential services that its tenants are providing, they are able to reopen and resume operations faster than the hotel counterparts. As a result, these net lease tenants are in stronger positions to continue paying their rents to SVC even as the economy struggles and adapts with the new norm. Observe from the table here, the occupancy level had remained very healthy at more than 98% throughout this period. In fact, year on year, rental income from its net lease portfolio increased 28.7% from $301 million in 2019 to $388 million in 2020. The increase was primarily a result of rents from properties SVC acquired pursuant to the acquisition of a net lease service retail portfolio from Spirit MTA Real Estate Investment Trust worth $2.4 billion towards the end of 2019. Going back to what I mentioned in the beginning, this net lease property portfolio is one of the key reasons for me to invest in Service Properties Trust. Because of this avenue of cash coming in, it can help SCVC to continue servicing its debt without having to liquidate substantial portion of its hotels to keep the business going. As at the end of first quarter of 2021, SVC holds about $7.2 billion worth of debt, including $1 billion revolving credit facility. This works out to more than $340 million in interest expense alone on an annual basis, and this will contribute to the bulk of the corporate expenses. Using 2020 income statement as a reference, the cash generated from the net lease properties should amount to about $370 million, and this will be able to cover most of the corporate expenses, including interest expense. And this is one of the key reasons why I think Service Properties Trust is a safer bet than a pure hotel investment. The next reason for investing in the travel-related industry is the signal of a strong recovery in the hotel sector. I have discussed in more detail in a previous video, so I will not go into too much depth here. But here you can see that if we just look at the data in the US, the past 3 months, March, April and May, the number of booked nights for hotels in the US has recovered way above that of the levels in 2020 and even surpassed the levels in 2019, a time before COVID. And travelling has become such a deeply rooted human nature that it is hard to drop entirely even in a post-COVID world. With the tracking, isolation and vaccination measures in place, we are in a better position today to not only fight but also adapt with the virus. Eventually, we will resume our travelling activities. The only question is when. Just for reference, revenues were $1.27 billion and $2.32 billion for 2020 and 2019 respectively. Correspondingly, SVC's normalized funds from operations FFO per share were $1.23 and $3.78 for 2020 and 2019 respectively. Understand that the REIT had been trading at around 7 to 8 times FFO per share previously before the outbreak of the coronavirus. This means that at the current share price of around $12.50, it could potentially 2x or more once its hotel operations resume to near pre-COVID levels. In fact, analysts estimate that the revenue will recover slightly to $1.48 billion in 2021 and climb higher to $2.03 billion in 2022. As for the consensus estimate for its FFO per share, it will decline to 27 cents in 2021 before climbing up to $2.20 in 2022. The rebranding transition that's continued in 2021 will have a negative impact on SVC's hotel revenue. Similarly, management's taking up of the revolving credit facility to increase its liquidity position will add on more interest expense for the year. As such, we will expect a lower FFO for fiscal year of 2021 despite expectations of its hotel segments picking up compared to 2020. Anyway, at $2.20 FFO per share and a price to FFO multiple of 7.5 times, it will translate to a share price target of $16.50 in 2022. At the current share price of around $12.60, if analyst revenue and FFO estimate in 2022 materialize, a price target of $16.50 will translate to an upside of more than 30%, and this is a pretty good return on an annualized basis from now. In fact, the bonus is that if the recovery of travel comes faster than expected, Service Properties Trust share price could even 2x in 2 to 3 years' time. Of course, there's still much uncertainty on many fronts. One such factor will be the level that business travel will recover moving forward as companies become more adapted to use technology for communication purposes. As such, it would be difficult to come up with a more accurate projection as there's still a lot of uncertainties as we maneuver through the pandemic. But I would say that again, given Service Properties Trust diversified portfolio in net lease retail properties, it can help to weather further storms related to the pandemic. It is definitely better positioned to overcome any new waves of virus strains or prolonged recovery compared to a pure hotel portfolio. On the other hand, the positive note is that we are seeing signals of strong recovery in the travel sector accelerated by the pent-up demand. With more knowledge about the virus and the vaccination and preventive measures in place, I'm pretty positive on the recovery of the hotels sector moving forward. and I think the risk-reward ratio is pretty favorable for Service Properties Trust, so I will be adding positions of SVC to my portfolio to take advantage of the recovery in the travel sector, while considering that the downside is protected given its diversified portfolio in the net lease retail properties. Let me know your thoughts on this and share with us in the comment below, and remember to subscribe to our channel so that you can be informed once our next investing tip is out. In the meantime, check out the recommended videos here to continue learning so that you can make better investment decisions. Keep learning and happy investing, and we will see you soon.